Welcome to the e-learning course on Basic Insights to SaaS Metrics, your first step to mastering SaaS. Over the next 20 minutes, we'll cover the essential numbers every founder, operator, and investor should understand to build and grow a recurring revenue business. Please note that in order to improve your learning experience, we have used an AI avatar to assist with narration. In this module, you'll get a clear introduction to the most important SaaS metrics and why they matter. We'll start by explaining SaaS metrics as the mutual language for tracking performance. Then we'll cover revenue fundamentals like MRR and ARR, retention metrics like churn and net revenue retention, and finally unit economics, including CAC and customer lifetime value. By the end, you'll know exactly what to measure, how to interpret it, and how SaaS businesses evaluate growth. Chapter 1, the mutual language. Let's start with why SaaS metrics matter and how they align decision-making across a business. SaaS as a service provider's rise began in the early 2000s, causing the replacement of traditional on-premise software, as it necessitated a new set of financial and operational metrics. The traditional method of accounting shifted focus to upfront license sales. However, SaaS relies on recurring revenue and long-term customer relationships. This shift created the need for specialized SaaS metrics to accurately measure a subscription-based business's health and value. Today, SaaS metrics are not only used in SaaS businesses, but also in other types of businesses such as e-commerce, where customer retention and acquisition are important growth drivers. This shift created the need for specialized SaaS metrics to accurately measure a subscription-based business's health and value. Today, SaaS metrics are considered the most valuable KPIs for value creation, and a mutual language used between investors, management, the board of directors, and the shareholders to monitor and measure value creation. They are also an extremely efficient tool for communication and setting mutual goals across internal departments. For investors, they are an extremely important tool because they illuminate the fundamental drivers of the business and are used for valuation. For management, they provide a daily operational dashboard to identify bottlenecks and drive growth. For the board and shareholders, they offer a clear, standardized framework to evaluate performance against peers and assess the return on investment. Internally in the company, finance often acts as the center, reporting unified progress to management, while marketing, sales, and customer success measure pipeline, sales, and sales efficiency. SaaS metrics are your navigation system. They help sales and marketing, founders, finance teams, and investors speak the same language and make decisions based on facts rather than assumptions. With SaaS metrics, our business health can be distilled into 5 absolutely essential questions. These are the metrics that determine whether we are thriving, surviving, or stagnating. Revenue. Are we successfully winning new clients, and what is the total revenue? Retention. Do we keep the clients we win, and what is their contribution to our overall revenue base through renewals and upgrades? Churn. How many clients are we losing, and what is the exact revenue leakage related to that loss? CAC. What is the true comprehensive price for winning a new client, and is the payback period fast enough to fuel sustainable growth? CLTV. What is the total estimated customer lifetime value of a client, and is that value worth the investment we make to acquire them? These are the metrics that translates into actual, tangible cash flow and the efficiency of our working capital. We will now run through these 5 main pillars of the SaaS metrics KPIs. Now for Chapter 2, which focuses on everything to do with revenue, such as MRR and ARR. The monthly recurring revenue is an extremely important SaaS metrics pillar as it shows your real growth, and it is fundamental to get correct to ensure that almost all other SaaS metrics are accurate. When you know your MRR, you have also found your ARR, or your annual recurring revenue. The simplest way to project your ARR from MRR is to multiply MRR with 12, assuming that the current MRR will continue for the next 11 months. MRR is the starting point for most other SaaS metrics, so please pay attention to this chapter. How do we define what MRR is? Well, it's simple. The predictable revenue a company can expect to receive every single month from its active subscriptions or contracts, normalized to a monthly figure. This is a simple calculation for simple businesses, but in reality, it becomes more complicated to build when companies have many products with different prices and service periods. To get your SaaS metrics correct, you have to know the term recognized revenue. Recognized revenue is the revenue that is formally earned and recorded on the financial statements according to accounting standards, like GAAP or IFRS. In a subscription business, this means revenue is recognized over the subscription period as the service is delivered, not all up front when the customer pays. Normally, MRR only includes recurring business and excludes one-off business, like consulting, hardware, or onboarding fees. An important task is to select the products that are included in MRR. It can be difficult to keep an overview of your MRR when having many customers and products. An important tool is the MRR sheet, which is the total overview of your customers and what products they buy, split out in months. This overview is necessary to define churned MRR, downsell, and upsell. We will dive into this in later Metriks e-learning modules. What is a good MRR? Well, this depends on the phase of your business, but what is most important is the benchmark to the competitors and your industry. Your market share, of course, depends on your MRR compared to the whole market. And your growth rate should be compared to the growth rate of your industry, which is the real signal to investors, for example. This is also why MRR is an important tool when evaluating companies, such as the Viking Growth Nordic SaaS Index and the Bessemer Cloud Index, which are both benchmarks that track the performance of B2B software as a service companies for valuation purposes. Now, for Chapter 3, let's talk about churn, often called the silent killer of SaaS businesses. To define churn, it simply means customers leaving. It measures how many customers, or how much revenue, you lose over a given period. In order to gain a deep understanding of churn, we have to dive into the two formats of churn: the financial recognition method versus the customer success churn. Firstly, the financial recognition model. For example, imagine you have a gym membership that runs until the end of the month. On January 10th, you tell the gym, "I want to cancel my membership." The gym confirms the cancellation, but they also tell you, your contract is still active until January 31st. So even if you have cancelled, you still have access to the gym, and the gym must still periodize the subscription revenue until the contract officially ends. With the financial recognition method, churn is recorded on the date the revenue is no longer recognizable in the financial system, meaning the day the contract ends and billing stops. So in this example, churn is counted on January 31st, not on January 10th. Secondly, the customer success model. Let's explain this method using the same example. You have a gym membership that renews monthly. On January 10th, you log in on your membership and you cancel the membership. The gym then informs you, no problem, you can still keep coming until January 31st. So technically, you still have access for the next few weeks. But here's the key point. With the customer success method, churn is counted on the day the customer tells that he cancels, although the actual end date is later. So with the customer success model, churn is recorded on January 10th, the moment you clicked cancel, even though the membership is still active until January 31st. This method is often preferred for operational metrics because it creates an early warning signal. It tells the customer success team early, this customer is likely leaving, and we should take action now if we want to retain them. Next, let's dive into how we can measure churn. Churn is often shown in these primary ways: the customer churn rate and the revenue churn rate. The customer churn rate is the actual number of customers who left during a period, divided by the total number of customers at the start of the period. It tells you the percentage of the number of customers you lose within a given period. The revenue churn rate, or MRR churn rate, is the recurring revenue lost from churned customers during a period, divided by the total recurring revenue at the start of the period. It tells you the percentage of your existing revenue that you lose because of customers who leaves. And here is a sneaky one which you should be aware of. It's called the hidden churn. Many companies only measure their customer churn when their customers have fully left. By far, the biggest decline in revenue is often due to customers buying less than before, which is called contraction or downsell. You should try to have KPIs that measure the share of wallet with customers, which is the percentage of a customer's total relevant spending that goes to your company. Proactively measuring contraction provides an early signal of dissatisfaction. Well, how can we become better at interpreting churn? First, we have to ask ourselves, what is a good churn number and what is a bad churn number? The most important measure is to look at it over time and constantly improve the number. Big variations or a sudden reduction indicate a major event that needs to be handled. Most importantly, it is essential to compare the MRR loss with the MRR win. To create growth, the win must be considerably higher than the loss. Furthermore, it is valuable to look at cohorts. If most customers are leaving after the same period, it indicates an operational leakage, which is a product bug or lack of customer success follow-ups which must be repaired. Besides being an important indicator of the strength of your business, churn is necessary to calculate the customer lifetime value, CLTV. Churn is furthermore important for forecasting revenue and is thus an essential KPI in the budgeting process for a SaaS business. The reciprocal of churn is called retention. Retention measures how much you keep, in contrast to customers that you lose. Net revenue retention is one of the most crucial KPIs for investors and analysts to measure a company's growth potential. NRR measures how revenue from existing customers develops over time, accounting for upgrades, downgrades, and churn. Think of it as the king of metrics. A high NRR shows that the company is able to generate more revenue from its existing customers than it loses. It is therefore one of the most important key metrics for both management and investors. So why NRR is so important? Well, NRR is a strong indicator of a company's ability to create repeat business and long-term growth. A company with an NRR above 100% is able to grow exclusively via existing customers, making it less dependent on new customer acquisition. This is particularly attractive to investors because it demonstrates strong customer loyalty and high value from the customers the company attracts. When a company has a high NRR, it also indicates higher upselling or price increases. It is an indicator that the product creates real value and that the company has a successful strategy for customer satisfaction and upselling. NRR is calculated by taking the total revenue from existing customers, including upgrades, downgrades, and churn, and dividing it by the original revenue from the same customer segment. Let's take this example. If a company starts the month with revenue from existing customers of €100,000, and in the same period gets €20,000 in upsells, but loses €5,000 in downgrades and €10,000 in churn, the ending revenue will have gone up to €105,000 from €100,000. The NRR will then be 105%, which means that the company has increased its revenue by 5% from existing customers, before accounting for new customers. And finally, Chapter 4, diving into how we measure unit economics through CAC and customer lifetime value. Next up, we will discuss what customer acquisition cost is. It is also called CAC. CAC is a crucial key metric that measures what it costs to attract a new customer. It is a central KPI for companies as it provides insight into how effectively marketing and sales efforts convert new customers. So why is CAC important? CAC is an essential metric because it helps with optimizing investments in sales and marketing. It shows whether growth is profitable, provides insight into how quickly a company can grow in a sustainable way, and supports decisions on resource allocation. Which leads us to the next logical question: how is CAC calculated? So, the most basic formula for calculating CAC is sales and marketing costs divided by the new customers. Let's take a look at an example. A company spends €50,000 on marketing and sales in a month, which is the total acquisition costs, and attracts 50 new customers. So to find the CAC, you just take the €50,000 and divide that by 50 customers, which equals €1,000. That means the variable costs used in the sales work to attract customers must be defined. These will be the costs involved in the lead generation and sales process that result in a sale, typically all marketing expenses, sales salaries, and other sales work in the form of trade shows and travel. The effect of investments in sales rarely coincides with the timing of the customers signing the contract, and therefore the CAC should be considered over a longer period, depending on the length of the sales process. This is done by considering the CAC as an average over a longer period corresponding to the sales cycle, as you see on the graph here. Here we use the average over the full period. What is customer lifetime value? The customer lifetime value is a key metric that estimates the total revenue a company can expect to earn from an average customer throughout their entire customer relationship. The CLTV is crucial for understanding how much a company should invest in customer acquisition and customer loyalty to create profitable growth. A quick method for calculating the customer lifetime value is to divide 100 with the monthly churn rate, and then we know the number of months the customers stay with us. Once CLT is calculated, the CLTV can be calculated. CLTV is the product of lifetime length multiplied by customer revenue, and the calculation of the lifetime, that is, customer lifetime or CLT, is central to a correct CLTV. So let's explain that with the following example. If a customer, on average, purchases for $500 a month and remains a customer for 24 months, the CLTV will be $12,000. However, it should be noted that a more precise method can be used taking into account the size of cohorts or the fact that unchurned customers have a longer lifetime. So what about gross margin? When calculating the net value of CLTV, the direct costs related to providing the service or product to the individual customer must be taken into account. This calculates the gross margin of the CLTV, often called CLTV net or gross margin CLTV. And why is CLTV so important? Well, CLTV is important as it is an essential KPI. It helps companies identify the most profitable customers, optimizes budget allocation for marketing and customer acquisition, supports decisions on pricing and product development, and it improves customer segmentation and personalized strategies. Now we have covered the absolute basics of SaaS metrics. Let's have an appetizer to the use of advanced efficiency indicators that combine multiple metrics to tell a bigger story. A good CLTV depends on the industry and the company's business model. However, an important rule of thumb is that CLTV must be at least 3 times higher than customer acquisition cost, CAC, to ensure long-term profitability. We call that the customer lifetime value to customer acquisition cost ratio. Having a 3:1 ratio means for every unit of currency you spend acquiring a customer, you'll earn 3 units in lifetime value. Now the rule of 40. This rule combines your growth rate and gross margin. If those two numbers add up to 40% or more, your business is performing well. Pretty simple, right? Now let's look at this visual to bring the rule of 40 to life. Here you can see 2 components, the company's revenue growth rate and its gross margin. The key idea is simple. When you add these 2 numbers together, the total should reach at least 40%. In this graphic, if you are in the green field, you are above the 40% combined. If you're in the red field, you are below 40% combined. This is why the rule of 40 is so useful. It shows that companies don't need to be both highly profitable and fast-growing at the same time, as long as the combined performance meets or exceeds 40%. Now we'll take a look at the magic number theory. This theory measures how efficiently your company can turn sales spend into new revenue. The magic number formula takes the quarterly recurring revenue growth and divides that by the previous quarter's sales and marketing spend. Again, there is no general rule of the right magic number, and you decide what the right level is for your business and industry, and you should measure to improve. But the rule of thumb is that a magic number below 0.8 indicates that you're not converting your spend into growth efficiently. You've now completed our module on SaaS metrics fundamentals. Before we wrap up, let's quickly recap what we have learnt. First, MRR is the foundation. If your monthly recurring revenue isn't built correctly and aligned with recognized revenue, most other metrics will be inaccurate. Second, churn and retention tell you if customers stay. Measuring churn early, especially through customer success signals, gives you time to react. And net revenue retention, or NRR, shows whether existing customers are generating more value over time than they lose. Third, CAC and CLTV show whether growth is profitable. CAC tells you what it costs to win a customer, while CLTV shows the total value that customer generates over their lifetime. And in most SaaS businesses, CLTV should be at least 3 times CAC. Finally, advanced efficiency metrics like the rule of 40 and the magic number combine growth and profitability into one clear performance signal. And with that, you now have the fundamentals to speak the same SaaS metric language as founders, operators, and investors. Congratulations, you've successfully completed this lesson on the fundamentals of SaaS metrics. Thank you for participating. We look forward to seeing you in the upcoming courses as you continue building your expertise.